Hello, this is Gary Schnitke, and this is a 5-minute Farm Doc Daily dealing with crop insurance for soybeans. Many farmers have expressed the concern that payments from crop insurance are very low. We looked at this issue using loss ratios. A loss ratio equals payments from crop insurance divided by premium from crop insurance, where a premium includes the farmer paid portion and the federal support for crop insurance. RMA has a legislative mandate of maintaining a loss ratio of 1.0. They often build in a reserve when developing premiums. The entire U.S. program has averaged 0.82 from 2002 to 2021, below that 1.0 benchmark. Soybeans is well below the average for all policies. In the U.S., soybean loss ratio has averaged 0.62 compared to 0.82 for the entire program. If we come to Illinois, Illinois has a lower loss ratio than the entire U.S. soybean program. The loss ratio for soybeans in Illinois is 0.48 compared to 0.62 for all soybeans. In Illinois, loss ratios are geographically distributed. In central Illinois, we have the lowest loss ratios. Northern Illinois has higher than central Illinois, and southern Illinois has higher loss ratios in general. But even southern Illinois' loss ratios are below that 1.0 benchmark. The county with the lowest loss ratio is Christian County with a 0.17 loss ratio. Farmers with concerns about the loss performance for soybeans can do two things. Most farmers are purchasing RP at a high coverage level. 80 and 85% are common in central and northern Illinois, 75 and 80 in southern Illinois. Two things farmers could consider. One is lowering the coverage level. And if we lower the coverage level from 85% in Christian County, and you could get down to $6.62 if we went to an 80% coverage level. That is using enterprise units. You could add SCO and get a 1152 policy, which is still below that 85% coverage level. Using SCO would get us back to that 86 in this case coverage level, but the band between the coverage level on RP and SCO would be county coverage. So one of the options is lower coverage level and supplement it with SCO and perhaps ECO as well. Another option is to go from RP to RPHPE, harvest price exclusion. Here we give up the increase in the guarantee. That happens usually in drought years like 2012. Giving that harvest guarantee provision reduces premiums, and a 85% coverage level becomes $7.37. We can add SCO and ECO to that 85% coverage, and ECO would get us up to a 90% coverage level, with the band from 90 to 85 being county coverage for $15.02, still below the RP coverage level for 85% standalone. The advantage of that would we would get a 90% coverage level, but what we would have to do is give up that harvest price exclusion. Crop insurance for soybeans has had low loss performance over the past 20 years and perhaps longer. Some of the things that farmers can do is lower the coverage level and maybe use SCO, or switch to RPHPE and also use ECO and SCO. You can read more about this in the Farm Doc Daily listed in the video description.